Hello and welcome to another episode where we're going to break down mortgage-backed securities and what happened to interest rates last week. This is the area that we're looking at. This is Monday to Friday, and let's break down what happened. All right, so on Monday, what we had was thoughts of the consumer price index preview coming up next week, and at first it kind of broke down and it tested this moving average here, and it was rejected. It closed above it, well above it, up to this point here. So basically what it's anticipating is the idea that they're thinking that inflation is going to show a better picture and that we're going to see what actually did happen here. So people kind of jumped on it. Early on, they were trying to think about testing this. There were people probably covering, shorts or whatever the case may be, and then they let it go. And the very next day, sure enough, inflationary numbers were in our favor year over year. It looks like we are down to somewhere decreasing from 4.1 to 4%. So that's a core inflation rate, and that strips out food and energy prices, things like that. Year over year, that core CPI actually decreased, which is exactly what we want to see. Additionally, we see that shelter, which makes up about 40% of the core index, which has been rising. It's continually rising, but it's rising at a slower rate. So if you look year over year, we're actually falling 2.5%. So we're actually looking better as far as that's concerned. Motor vehicle insurance, health insurance, things like that are still rising. We're still seeing things increasing, but year over year, remember this is a 12-month moving window. We're starting to see that inflation is getting lower, which is awesome. We also saw weak seasonal hiring. And weak seasonal hiring is suggesting that the retailers are expecting that we're not going to necessarily have as huge of sales as we usually do, and or they're holding on to their core employees and they're just not hiring additional. So they're trying to do more with less, again, trying to cut or save their own profits because they're seeing that spending is actually starting to slow down. If we look at the following day, which is here, you have a lot of people that are probably said, hey, this is great. We're going to actually kind of take our profits here. So it did impact it a little bit, but it was rejected. And it really kind of fits in this technical picture of this moving average right here that we see. At the end of the day, it was really about looking at retail sales and mortgage applications, things like that. It really wasn't necessarily a market moving. It fell more into the technical range after such a huge couple of days of fundamental news. The October producer price index showed overall producer inflation decreased by 0.5%, which is lower than the estimate of 0.1%. And it's the largest decline since April of 2020. All that being said, it was still more of a technical day, right? The next day that came in, we are dealing with initial jobless claims. And this is significant because what it's showing is that for the first time, it rose 13,000 to about 231,000, which is higher than expected. So although it doesn't seem huge, it is showing a trend of increasingly higher and increasing layoffs. And continuing claims is the other side of that, where those rose 32,000. And what that is saying is that not only are people not hiring, but those that they let go, those people that are let go are having a harder time finding a replacement job. And that kind of goes in line with the fact that they're holding onto employees, they're not hiring new employees. Also, import prices fell, right? So this is helped by gas and a couple of other things, but it's showing a weakness in the economy. And industrial production, which covers sectors like mining and manufacturing, electricity, gas, steam, stuff like that, that also fell. So what this means is that factories have a ton of available capacity. And when that happens, it means that either they have to reduce prices to increase orders to fill capacity, or they're going to start laying off. And this is showing a weaker jobs market. So that impacted from a fundamental standpoint, which was really good news. And then we walk into Friday. And on Friday, we're looking at housing starts and a couple other items, not really market moving because we had a lot of really big movement here. So basically everybody just kind of held in this range and it didn't move very far. But some of the news that did come out is showing that we have continuing supply and demand in the housing market. So when you're talking about how many houses are projected for this year, we're looking at somewhere around 1.41 million. On average, about 100,000 homes need to be replaced every year. So that leaves us about 1.31 million. So when you look at the projected household formation of 2 million, we're way below what we need in order to support the volumes. So you have housing starts that aren't matching the demand. So this is going to continue to show that we are going to see a strong housing market. Now, a lot of people are like, "Oh, doom and gloom," but we just don't have. It's just still supply and demand. Now, if we look at the technicals here and we see that we turned a corner, and if we can believe that this is the beginning of rates getting better, then you have to remember that for every 1% that we get better in rates, there's an approximate 5% correlation in increase in housing prices. So as we've been saying the entire time, for those of you who've been waiting to for rates to get better to get off the fence, you're going to negate the better rates due to higher cost of homes. So it's better for you to actually buy the house now and then refinance when rates get better. That way you're taking advantage of a lower price point and then later a lower interest rate. Overall, you're going to have a much lower payment than if you waited just for a lower interest rate. Now let's take a look at these technicals. We saw what happened in the fundamentals, but from a technical standpoint, this is really huge. If we look at this trend line here, I mean, it clearly broke above it, and we're dealing with broke above the 50% Fibonacci here. It came back below it and was testing it. This moving average it ended up as a support, pushed above it. So now we're in this range. More than likely, it's going to test this 38.2. Nothing that says it can't go back down again, of course, but typically you have support here and the next point of resistance here. Now, if we take a larger look at this, you see that this was a major trend line. If we do a line coming across the tops of these, it pretty much corresponds with this downward trend and this moving average and where it actually rejected it, and then we went back up again. So this is where fundamentals and technicals strongly supported each other. It could potentially mean that we've finally broken above this downward trend line. Now, there are larger trend lines, and you see this one, and we may or may not be too past it, and it could come back and test that. But it does appear as if it did go above it. So we're probably going to see it test. We're probably going to see it go into a range. And you can see that this is over the past year what it has done. It was in a trading range. It's come down, giving you a bigger perspective for the 2-year. This is where we were. You can see how far it went into a trading range, and then it dropped. Now we're coming back up. So ideally, hopefully, we're seeing that we are going to be moving in the correct direction. But you see all of this in here, this entire trading range is going to provide levels of resistance. Fundamentals are really the only thing that's going to push above this, and this is going to be the inflationary moves. So remember that rates increase really fast, and then they will get better very slow. So this isn't something that's going to happen overnight, although this is a huge relief, much appreciated, definitely helps with the interest rates, but it doesn't mean that all of a sudden we're going to have super low interest rates. It means that really essentially we're right back where we were back in August. Okay, so it's not really this earth-shattering, but it is a turning point, and that's what we have to remember. So positive, very exciting, and this is really the news that we have wanted to see. All right, if you guys have any questions, let me know. I look forward to hearing from you, and until next time, have a wonderful week.